International Monetary Fund has just released its annual World Economic Outlook, and the IMF cut its global growth forecast, saying that the recovery is stalling. With us now in his first interview since the report was released is Jose Vinals. He's a financial counselor and director at the IMF. Welcome to In Business, sir. This report says we are deeply into the danger zone. What does the IMF say here?
Well, what the IMF is meaning by deeply into the danger zone is that we have now entered into a new dangerous phase of the crisis, the epicenter of it being in Europe, and that it is fundamental to take urgent action in order to stabilize the situation before this leads to something which resembles an extension of the global crisis.
Do you expect that Greece will be able to make that March 20th payment and that it will not default on its promises to credit holders?
Well, we expect that Greece, first of all, would be ending the discussions with the private sector so as to agree on a reasonable private sector involvement operation that can help restore debt sustainability in Greece. We hope that we can put together a program for Greece together with the European partners, a realistic program that, if implemented, would also lead to Greece improving its medium-term growth outlook, and that among this combination of private sector involvement, the program, and official financing from the European authorities and the IMF, that we can have a positive outcome to the Greek issue.
So you think that the European Central Bank needs to get more involved?
Well, the European Central Bank has gotten involved a lot in the last few months in the provision of
creditor negotiations.
Well, I think that this is something for Greece and its creditors to decide. The role of the IMF is, at the end of the day, when these negotiations have produced an outcome, we will see whether this outcome is consistent with the sustainability of the public debt in Greece. And that would be fundamental for us.
What would a credit event look like? S&P out today saying, regardless of how the creditors and the Greek government structure this deal, they see and classify this as a default. What would a credit event look like in that scenario?
Yeah, I think there are differences in terms of what we mean by a credit event. You may have a rating agency which downgrades the Greek debt as a result of the exchange, and you may also have something which is a true credit event, not a ratings event, which is that CDS contracts, credit default swap contracts, are triggered, and that's a different thing. Fortunately, the Greek CDS sovereign market is rather limited in terms of its net amounts. The gross amounts are larger, but the net amounts are smaller. So if there is no counterparty risk failure, then we think that this is something that would not be a problem.
But in your report, you say that there needs to be a credible increase in banks' capital buffers. When you're looking at that degree of increase, I mean, how much is that influenced by these negotiations right now? Are they adequately prepared for a default, a credit event situation?
Yeah. In the increase in capital levels of banks in the European Union, about 30 billion euros have been earmarked for Greece. So that means that this is the amount which is earmarked in this exercise to take care of the risks coming in Greece from various factors, including from the present negotiations. And the rest is something that other European banks have to raise in order to be prepared to cope with the uncertainties in the present environment.
All right. Thank you very much, Jose Vinals of the IMF, for giving us that latest take on the risks to the global economy.